Hi Ben, Ash here. I wanted to get your views on growth bonds and setting them up for kids and what the benefit is from a tax point of view, and how to best, I suppose, maximize the investment so when the kids are older, they get a bit of a helping hand to start off.
Hey Ash, thanks for the question. And yes, look, happy to help with this one. I think investment bonds are a super interesting product, and there's some interesting strategies that sit around them. Now, these products were particularly popular back in the '90s and 2000s, and then essentially they fell off the radar mainly because as the investment product space evolved, what happened was that most investment products became cheaper over time, but these products, because a lot of them were legacy products, they ended up being quite expensive for what they were relative to other products. And so people started using them less essentially. But the market has gotten more competitive in recent years. And so they're back being something that can make a lot of sense for people in the right circumstances. Now, investment bonds, growth bonds, insurance bonds, they go by a bunch of different names, but they essentially bonds that or investment accounts that are subject to concessional tax treatment provided you meet certain criteria. Now, there are two parts to the tax concessions that you get through an investment bond. The first is that there is an internal rate of tax that applies on the income. That maximum rate of tax is around the 30% mark, which means that particularly for anyone whose marginal tax rate is higher than that, it means that the ongoing dividend income that you receive from a share portfolio or any interest income from defensive investments like bonds or term deposits or cash or other sorts of investments like that are taxed at a lower rate than you would pay in your personal name, because in Australia, if you earn more than $45,000 a year, your marginal tax rate is going to be 34.5%. If you earn more than $120,000 a year, your marginal tax rate is going to be 39%. And if you earn more than $180,000, your marginal tax rate is going to be 47%. So having that income tax at a maximum rate of 30% is going to mean that you're increasing your after tax return, meaning that your investments can essentially grow faster. The other big kicker, though, from a tax perspective, is that with investment bonds, so long as you meet the rules around how much you contribute each year, and I'll unpack that in a little bit more detail. But so long as you meet those rules, and if you hold the investment for longer than 10 years, the all of the capital gains are received entirely capital gains tax free. So you essentially pay no tax on the capital gains on the growth of the investments over time, which is a pretty significant advantage and means that you can, again, you're really pumping your after tax return, meaning that your investments build faster. You do, though, need to satisfy those contribution rules, which means that you do need to leave the money there for a 10-year period. You also can contribute each year, but you can contribute no more than 125% of what you contributed in the previous year. So if you contribute $100 in one year, the maximum you can contribute and get the tax concessions for in the following year is $125, and then so on and so forth. So this particular product and the strategies that sit around it, again, reasonably complex. If you're thinking about going down this path, probably a good idea to get some advice, support, guidance so that you're dotting your I's and crossing your T's. But it can give you some significant tax advantages and ultimately mean that you're building your investments much faster.